A Bala joins us now. Let's take a conversation forward. Let's understand from him that right now what is the best way to approach this market. Bala, fantastic to have you back. Thank you for joining us. It's been a good year. It's been a good run. Is it time to exercise caution or is it time to just enjoy the joyride?
I think one should continue to remain bullish for a variety of reasons. One, the Indian macro fundamentals continues to get better and better, whether related to the interest rate movement, inflation lot under control, macro factors like fiscal numbers are far under control. For currency reserves have been rising, current account deficit is almost coming to the positive kind of levels, and flows also been quite decent. On top of it, as you earlier mentioned about some of the results of the current quarter, reflects the buoyancy that we have been talking about it in terms of real numbers. There is no disconnect between the earnings of the companies and the market momentum, and there is no disconnect between the macroeconomic factors and the fundamentals of the market. So that's being the case, I would assume the buoyancy will continue. I think valuations is always a question mark which comes. I have seen historically the valuations will come under the question mark only if the economic growth gets stopped or it actually gets into the reverse gear, and which is not doesn't seem to be the case as it stands today.
And these only flows which are driving the market, because I agree the macro tailwinds are beginning. Earnings are okay, but earnings are going through incremental positive. There's an incremental change in macro. There is an incremental improvement in earning, but there's a marked improvement in the health of the market. There's a marked improvement in the way how mid and small cap stocks have recovered. So if the rate of change is going to be incremental, the market move has been exponential.
Right.
It is not adding up. This means it is a liquidity driven rally.
It is a flow driven. There is absolutely none of us are expecting, the whole market was not expecting the FII flows to reverse that fast. I think the speed at which they moved out, probably the same speed or maybe even the higher speed at which they have come back, is also because of the kind of flows that went into China did not have the right experience for them. Therefore, emerging market allocations, which I am told, 35% of the emerging market allocations that come in the last 3 months have come to India.
35% of the total allocations which come to emerging markets have come to
India, which is one of the highest that we have ever seen.
And is that likely to increase going forward?
I think it could, because the more you talk to the overseas investors, the more you see how global markets are looking at India. It's completely different from what we have seen maybe about 3-4 years back. Therefore, the FDI and FI's flows, I think would probably continue to remain strong. NRI remittances have been rising, which again, despite the overseas interest rates are quite high, and there is absolutely no need to remit in India because they will get enough opportunity they will get in overseas market. But given also the fact that if among the developed market, US, assuming scenario it gets in some kind of recessions, then naturally they have to go after the market which has got some promising growth aspirations. That I think India probably figure in that. There's absolutely no denial on this, Nikunj. I think flows always have been a primary driver. And fortunately, when there was an FII's outflow, domestic institutional investors actually came in handy to protect the downside, and therefore that gave us the stability.
Why are they selling right now, Bala? Because on a daily basis, in the last leg of the rally, about 400 odd points, DIIs have been sellers.
I think it's always a good sign. Whenever we see the rate of flow, I think even in mutual fund industry, the rate of flow have also reduced a bit. I think there used to be about 25 to 30,000 crores kind of net inflows. Now it's come in the range of about 9 to 11,000 crores kind of net inflows. So that's the range in which it's come.
Must be more, no? Because SIP is 15, right?
SIP 15, I think if you look at the aggregate.
The SIP minus outflows.
SIP outflow, if you take, the net inflow is about 11,000 crores, and on average we can take at this point of time. The run rate used to be somewhere around 24, 25. And which I'm not worried about it, because this flow is actually always, we have seen this kind of transition period. But these flows will of course come back as we start seeing the good experience coming in. I think the fact of the matter is domestic investors selling in for, of course, either for increase a little bit of cash levels, as you may pointed out, are we in the, is the market is running too fast? Maybe some bit of profit booking will come. This time, fortunately, the majority of the companies which did not perform well for the last 2-3 years have started performing, like FMC companies, MNC companies, who have been underperforming for quite some time. Suddenly we saw actually renewed interest because valuation at the end of the day is catch up. So it's moving from one to other, I would say. But I think in the broader basis, if you look at it, I think the buoyancy remains. Even the recent monsoon concern which was there, like El Nino effect will have a huge impact. In fact, the rain god has been quite kind for India.
Yeah.
Yeah, and so just wanted to get in your perspective then, given that you're talking about all of these factors being supportive, where is it that you are, looking at strong potential? For instance, the auto sector has really seen a strong up move. Do you think that now the road ahead is also looking promising, or a lot of the positives have been baked in?
I think auto will continue to see a revival, especially with the economic growth coming back, and then supply chain is getting better, and infrastructure investment continues to remain very, very strong. I will probably see commercial vehicles, even passenger vehicles. We have been seeing some kind of pickup. Buyers are coming back, and there is also economic model seems to be suggesting that commercial vehicles probably they'll make more money, right? That's the way I think they all take the buying decisions. So that seems to be happening. We are seeing some kind of revival in the rural economic spending. I think the agriculture output continues to remain very, very strong, which is the case as of now. I think the rural spending will come back. Therefore, I also believe that FMG sectors also could get the benefit. I think other area where the market is discounted, I think not just only about growth in sales coming in, the input cost has come down quite substantially. I think if you take oil price led input cost has been quite stable, rather down I would say. For automobile sectors, input costs coming from the steel and aluminum prices are down. So these are some of the things also is playing a role in some form or other in terms of margin improvement. Therefore, the numbers will look better and so on and so forth. But I think broadly, if you look at consumer spending, I would assume would start picking up. In addition to the sectors which have been bullish like automobiles or capital goods sectors or the banking and financial sectors. And credit growth itself reflects how consumer behaviors are happening in the country. And the recent report also once again reinforces that the banking system is very sound, NPA levels are the one lowest, and default ratios have been coming down. These are actually something we should feel proud that yes, banking system got streamlined so much last 4 or 5 years. The risk in the system is also to the extent gets reduced.
So Bala, when we started the year, the general view, and that's your house view, was that you will get 10 to 12% return. That is what should be expected. You got that in 3 months.
Yes.
So what you expected to get in full year, you've got in 3 months. Because
Now
I'm
what?
going by now what? So do you say that, okay, I'm going to ride or I'm going to book my profits? Because I'm just going to go back to your projections when you did your annual Birla AMC summit. You said equities 10 से 11%, fixed income 5 से 7%. That was the expectation. That has happened in 3 months.
Correct.
So then what?
I think
So you have to change your prediction or book profits. एक तो करना पड़ेगा.
We have done some
Change the
analysis.
guidance upwards.
No, that view
revise it
doesn't change,
upwards.
frankly. I think we have done some analysis. In every 3-year cycle, if you take the last 25 years, you put in a 3-year bucket, every 3-year market forms new high, and every 3-year, within the 3-year market also forms a low. That low is always higher than the previous 3 years low. I think it's a little up compared to the previous years and keep moving up like that. So also, of course, have to catch up with the earnings as well. But from investors' point of view, the 12 to 15% is the expectation that one should have in equities. A simple mathematics, which is nominal GDP plus risk premium.
So don't redeem your units.
Yeah,
Don't redeem your units.
That doesn't change. I think we'll have to just stick to that. I think market, whenever gives an extremely high return, we should feel happy that I got it. The bonus as one time, not necessarily it'll get repeated all the time.
So you're
But,
bracing for a fall is what you're saying.
even market goes through consolidation phase. As we have seen in the last 2 years, and if you look at the Nifty and Sensex, remain more or less flat. At the same time, certain sectors did exceedingly well. I think we saw a huge divergence in terms of sectoral performance. We saw whole of last year, ITS sectors gave negative return, did substantially lower than the index itself. If you look at index outperformance, index underperformance, there's huge deviations. And it's also coming on the back of the increased breadth and depth in the market, also making such kind of volatility. From money manager's point of view, need to have construction of portfolio. We'll have some winners, we'll have some losers. But expectation point of view, then the 12 to 15% kind of expectation should always remain as far as the equity is concerned, even if you go by the historical standards.
What about IT? You think worst of the price damage is behind us?
I think the balance sheets are strong. I think the companies are sitting on huge amount of cash, and they still remain relevant from the global outsourcing point of view. The recent example of Infosys winning huge orders now, it's all reflection of the role that they all play in the international market on the IT as a technology space. Therefore, ultimately, everywhere the valuation will catch up. Market punishes them for a variety of reasons. AI as new has come, and definitely it pulled up certain sectors globally. We'll see its own consolidation phase. There is a different school of thought that exists. Unfortunately, Indian IT companies, all the leaders, major Indian leading IT companies, have also made their course correction in the last number of years. After seeing the IT fall in the year 1999, most of the companies have changed the business model in such a manner they remain relevant throughout the period, given the fact there is a role that they play. So I think if you go by that, strong balance sheet, ability of the companies to buy back shares, give a high dividend payout,
Adaptability.
adaptability, I think all those things should definitely help in IT companies to come back on the radar.
So for the moment, which to your mind is the most overrated sector and the most underrated sector?
I think I would say more than overrated, sectors like even the banking and financial sectors run up quite a lot, and on the basis of expected growth, etc. And I'm not saying overrated. I think probably it has to go through some kind of consolidation phase, which I think could be one. Second is again auto sectors, like some of those stocks have run up quite a lot on expectation that growth will come. So again, we may have to go through a consolidation phase. At the same time, there are certain sectors which are getting impacted because of exports not being up to the mark, like textiles. I have seen a complete last 2-3 years. I have seen a complete declining phase for a variety of reasons, because the global markets are not been conducive enough for them to make money. This probably can say got hammered so much. Maybe there is somewhere down the line we will see some kind of pickup coming in. And I think it's a mix. I think it's very difficult to point out on any specific pure fundamental basis. Because I'm going by the market, the way the market rewards and punishes.
Sure. Bala, great to have you in the studios as always. We are glad that you could take time out.
Thank you.
Thank you so much.